guys, it's Stock Curry. In my past few videos, I did some historical comparisons to see how the stock market might perform if history were to repeat itself. Today, I'm going to give you the bull case and show you how the stock market might go up 20%. So let's get into it! Okay, before I show you how the stock market could go up 20% this year, I want to clarify that in my past few videos, we were doing historical comparisons, meaning we were looking at how the stock market might perform if history were to repeat itself. These are not my predictions, this was just a look back at history, meaning it was neither good nor bad, it's neutral, it's history, it's facts, it is what it is. Now, the first thing I did was I looked back 70 years and noticed how every single time the Fed raises interest rates, it causes a recession within 6 to 18 months of the Fed starting to raise interest rates. So if history were to repeat itself, we would see a recession start somewhere between October of this year and October of next year, assuming the Fed starts raising interest rates in March of this year. The other thing I did is I went back and looked at history to find the most comparable time period to what we're in right now, and I found that 1973 was the most comparable time period. And during that time period, the stock market fell for 2 straight years. Now today, I'm going to look at the bull case scenario and tell you how the stock market could rise 20% this year. Now, in order for the best case scenario to play out, we have to resolve the issues that we're currently facing. And the first issue that we're currently facing is inflation. Now, in order for inflation to go down, the Fed would have to raise interest rates to about double what inflation is. So with inflation at 7%, the Fed would have to raise interest rates to 14%. If inflation at 8%, the Fed would have to raise interest rates to 16%. But that's not what we're seeing the Fed do. In fact, the Fed is being very dovish, and they're saying that they don't want to raise interest rates by more than 1% this year. So if inflation is so high, why doesn't the Fed want to raise interest rates in order to fight it? Well, the reason the Fed doesn't want to raise interest rates extremely high right away is because the Fed believes inflation is going to fix itself. Now, to understand how that's possible, we have to understand why inflation rose in the first place. And the reason inflation rose is because consumer demand increased at the same time supply decreased. And if you remember from your basic intro to economics course, when demand goes up and supply goes down, prices rise in order to equal out that supply-demand curve. Now, the reason this occurred was twofold. First, supply decreased because of worldwide shortages due to countries shutting down due to the pandemic. At the same time, the government introduced unprecedented stimulus. In fact, over the past 2 years, half of all of the US currency in circulation today was printed in the last 2 years. Now, with the currency doubling in the last 2 years, you would expect the stock market to double in the last 2 years also. And that's exactly what we saw. From the lows of 2020 to the highs today, the stock market doubled in the last 2 years. Now, with there being double the amount of currency in the system today as there was 2 years ago, how can inflation possibly fix itself? Well, during the pandemic, consumer savings accounts skyrocketed. Consumers saved vast amounts of money. Then, once everything opened back up, consumers started spending what they had saved. This caused unprecedented demand in the market, and supply wasn't enough to meet that demand. Now that consumer savings have been depleted, we should start getting back to normal demand. At the same time, supply chain issues are getting resolved and businesses are reporting higher than normal inventories. So we have demand decreasing, at the same time we have supply increasing. And again, if you remember from your intro to economics class, when demand goes down and supply goes up, prices will go down to equal out that supply-demand curve. And as prices fall, inflation will fall to go along with it. And that's what the Fed is betting on, and that's why the Fed is unwilling to raise interest rates quickly. Now, the next issue that we need to tackle are these rising interest rates and how historically it always causes a recession. Well, remember how a recession is defined as GDP growth less than inflation for 2 quarters in a row. And the Fed believes that as inflation falls, it should fall below the GDP growth, which will help us prevent a recession. So if inflation goes down on its own, and especially if it drops quickly, then that means the Fed won't have to do so many rate hikes, and we could actually end the year with less than a 1% rate hike. Now, if this scenario were to play out, where inflation fixes itself and the Fed doesn't have to raise interest rates, then Goldman Sachs sees the market rising 23% from Tuesday's close. Now, again, it should be pointed that this is a best case scenario, and it probably won't happen. And we've heard the Fed give this rhetoric for over a year now, how inflation is transitory or temporary, and how it's going to go back down on its own. But so far, we just have not seen that happen. Not only has inflation not gone down, it's actually continued to rise. And there's a very good reason for this. While inflation so far rose from unprecedented demand due to an unprecedented printing of money combined with supply chain shortages worldwide, inflation is now rising for a very different reason. And that's because as prices have risen over the past year, businesses have had to raise their salaries in order to keep and attract employees. And that has caused buying power to remain strong as well as consumer demand to remain strong despite the fact that consumer savings have been depleted. So long as demand remains strong, inflation will remain elevated. So while we might not get the best case scenario, inflation could still fall on its own as supply chain issues get resolved and we could possibly avoid a recession. So while we might not see a 23% rise in the stock market, we could still see a smaller rise in the stock market as inflation goes down and market fears reside and things get back to normal. Okay, that's the bull case scenario for the stock market. Now, as I said before, this is not my prediction. I don't think the stock market is going to rise 23% this year, and I also don't think the stock market is going to go down for 2 straight years. It's important when you're trying to make your own prediction to look at the bear case and the bull case and figure out somewhere in between that you think the stock market might do. Personally, I'm going to reiterate what I've been saying since December of last year, that I think we'll get a 3 to 9 month correction in the stock market. So in other words, I think the stock market is going to bottom out somewhere between March and September of this year and then go up from there. Now, I don't know where the stock market is going to finish the year at, if it's going to finish the year up or down, but I do think that the bear market, the bottom, is going to occur sometime in the next month and a half to 7.5 months. And then after that, I think it's going to go up. All right, let's get into today's news so that you can make your own prediction of where you think the stock market is going to go to. Okay, the Producer Price Index, or PPI inflation numbers, came out on Tuesday, and they were really bad. Analysts were expecting a 0.5% month-over-month increase in the PPI, but instead the PPI came in at a 1% month-over-month increase, or double what analysts were expecting. The PPI in January was a massive 9.7% year-over-year. Now keep in mind that the Fed tends to use the PPI more than the CPI when making decisions, and that's because when wholesale prices rise, those increased costs are usually passed on to consumers, which means the CPI inflation numbers should rise to match the PPI inflation numbers at some point in the future. So this unexpectedly high PPI number will give the Fed more reason to front-load interest rate hikes in March, and possibly do a 0.5 or even 0.75 basis point rate hike in March, instead of just a 0.25 basis point rate hike. Now that was the bad news. On the flip side, we got really good news today. And that is that Russia withdrew some of its troops from the Ukraine border. Now that caused the stock market to rally despite the much higher than anticipated Producer Price Index. Oil also dropped 3% on Tuesday, falling below $91 a barrel at one point. Now, as I've been saying, oil prices are much more likely to fall than rise, especially if we get a complete de-escalation of the Russia-Ukraine crisis. And of course, declining oil prices will also result in lower inflation, which will be good for the stock market. Now finally, don't forget that the January Fed meeting minutes are going to be released Wednesday at 2 p.m. Eastern Time, or 2 hours before the market closes. Now remember, in January, when the December meeting minutes were released, the market absolutely crashed. So keep in mind that we could see massive volatility in the markets on Wednesday, depending upon what the January Fed meeting minutes have to say. I do expect that the markets could move plus or minus over 2% on Wednesday, and then possibly continue whatever direction that market moves on Thursday. So just be aware of that and be on the lookout for that. We could see major market movement on Wednesday starting at 2 p.m. Eastern Time. Okay, I do want to discuss 2 earnings that came out today, and the first one is ABNB, which is Airbnb. ABNB reported earnings after the close on Tuesday, and they beat estimates on both revenue and earnings. ABNB reported their second profitable quarter in a row at 8 cents per share. Now, revenue was also impressive at $1.53 billion versus only $1.46 billion expected. Those numbers were down slightly from last quarter, but that is expected due to the seasonal nature of ABNB. The share price rose 3% after hours. Now, using an average of the last 2 quarters, we get an annual EPS of $2.60, which results in a PE ratio of 71. Over the past 4 quarters, ABNB has averaged a 1,710% annual revenue growth. That is nothing short of impressive, although it should be noted that ABNB is comparing year-over-year growth to a time when the country was shut down due to the pandemic. Still, ABNB is on track to have its best year ever. Now, even with this year's impressive revenue growth numbers, the average annual revenue growth is only around 45%. So with a price to sales ratio of 32 and a price to earnings ratio of 71, ABNB remains very expensive fundamentally. Technically, ABNB is bullish in the short term, but with the stock price being overvalued fundamentally and with traders becoming more and more risk adverse each day, I don't think ABNB will maintain this upward momentum for long. And the next stock I wanted to talk about is RBLX. This is Roblox, and they're an online gaming platform. Roblox reported earnings after the close on Tuesday, and earnings were pretty good. RBLX saw $770 million in revenue, which is a massive 248% year-over-year increase. They also saw daily active users jump 33% to 49.5 million. Unfortunately, their earnings dropped to a loss of 25 cents per share from only a loss of 13 cents per share last quarter. And since their earnings loss widened, that was not good news for the stock. RBLX dropped 15% after hours. Unfortunately, even after that 15% drop, the stock remains expensive with a price to sales ratio of 46. Technically, RBLX remains bearish, although the golden cross on the MACD can't be ignored as an early indicator that RBLX might be near a bottom. Alright, I hope you enjoyed that video and get a lot out of it. Comment down below what you think the market is going to do in 2022. And remember, this isn't a time to get scared, it's a time to get prepared. What we're doing is we are hedging our portfolios with put options so that we can make money as the stock market goes down. If you want to learn how to do this, you can come join the coaching program where I teach you how to trade options. In the coaching program, Dr. Miguel Jasmine said he made a 75% profit in January on his QQQ put. So if you'd like to learn how to trade put options and make a 75% profit also, then join the coaching program where I'll help you and guide you and walk you through how to trade put options. Now finally, I want to remind you to hit that like button, subscribe, and click the bell icon if you haven't already. I hope you have a lot of success trading, and I will see you tomorrow.